Pam Seifert. On behalf of REMN Wholesale, we welcome you to our third installment in our Integrated Disclosure Series. Regulatory changes are becoming a part of everyday life in the mortgage industry, and as such, we at REMN Wholesale believe that educating our broker partners on Integrated Disclosure Rule is just as important as the broker experience and our commitment to same-day turn times. So already, a lot of you have reached out to me to ask for a copy of today's presentation. Well, we'll be happy to provide that to you, along with our Q&A, to all the participants once the webinar is completed. And also, at any time during the webinar, if you have any questions, please feel free to ask the question in the question box in the webinar panel. So a few of you have also asked, well, what happens if I missed the first or second webinar? Well, you could simply go to www.remnwholesale.com, click on Resources in the blue menu bar, click on Webinar, and you will see them posted there. So before we actually get started, I did want to ask a couple poll questions. Let me launch the first one. So our first one is, who is with us today? If you could just take a couple of moments, please, to answer that. We have a lot of people voting right now. Thank you very much. And I'm going to take another 5 seconds, and then we will close out the poll. Okay. Here we go, and we will share it with you. We have a lot of different people here, from brokers, lenders, realtor, attorneys, and 7% are other. So let's go to our next poll, and that is, if you could please rate your current TRID knowledge, or integrated disclosure knowledge. And we'll take that poll for a couple more seconds. Okay, I'm going to give it another 5 seconds, and we're going to close that out as well. Okay, I'm closing it out, and let me share with you. So here we have a fair amount of people that are familiar with the regulation, and a few know just a little bit enough to be dangerous, and just even a few who are not quite sure what integrated disclosures is. So that's great. We welcome everyone here to the webinar. So at this time, what I would like to do is introduce Bill Schultz, who's our General Counsel and Chief Compliance Officer. Bill?
Thanks, Pam, and good afternoon, everybody. I'd first like for the 1% experts to please send me your names so we can hire you as an employee here, because I think that at this stage of the game, we are 106 days out from this, and from August 1st, and I'm finding from my last 6 months of work that it's really hard to become an expert in this. But nonetheless, the goal of our session today is to speak specifically about the loan estimate. And on the previous 2 webinars, we introduced the new disclosures. We talked a lot of different things in a general fashion. The goal today is to get more into the specifics of the loan estimate. Some of this will be just about the form timing. Some of it will be about the mortgage broker's role and the wholesale lender's role. And I'm going to move at a pretty rapid pace just because there's a lot of material for us to cover. So jumping right in, the loan estimate, also known as the LE, combines the initial TIL and GFE. The LE will become the standard form for RESPA transactions starting in August. There will be certain transactions, such as HELOCs and reverse mortgages, that will still use the existing forms in place today. The CFPB did a tremendous amount of market research and focus groups on trying to come up with forms that were going to be easier for consumers to understand. So you'll notice the design principles of the form is that the text is easier to read, it's more visually appealing. The ordering of the information on the forms is also sequenced based on what they believe is the most important information to a consumer first. The other goal is for the borrower, the consumer, to be able to put the LE and the closing disclosure side by side when they go to the closing and actually be able to see what changed from when they started with their transaction all the way to closing. And if you think about that today, that's virtually impossible to put a GFE next to a HUD-1 and easily match up what changed along the way. So the goal is, once again, simplicity for the consumer, more transparency. Along the way with that, the forms are dynamic and they become more transactionally specific. So there are sections that they don't apply to the particular type of loan program or the loan type that will not appear on the form at all. Sections are left blank if they don't apply. For adjustable rate mortgages specifically, or adjustable payments, there are tables that will appear only if they apply to that particular loan transaction. And sections that don't apply, we cannot use, not applicable or NA for those types of field values. Next slide, please. Before we get into the form, I just wanted to reiterate some of the timing requirements. Much of this is what we're used to, with the existing rules from RESPA and TILA, but just wanted to point them out. First of all, the initial loan estimate must be delivered within 3 general business days after receiving the application. So that application can be received by either a creditor lender or a broker. As far as delivery goes, if the LE is not provided in person, receipt is assumed within 3 business days after delivery or mailing. And we're using the term general business day here because within the regulations there are the general business day, which is also known as the open for business day, when a creditor's offices are open to the public for carrying out substantially all of its business. And there's also the specific day definition, which is also commonly referred to as the rescission definition, which are specific business days, which includes all days but Sunday and specific federal holidays. So for the purposes of delivering the initial loan estimate, it's a 3 general business day requirement. Similar to what we're used to in the TILA framework with the 373 requirement, the transaction can close sooner than 7 specific business days once the initial LE is delivered. That's the same as what we're used to today with the TIL. And then along the way, obviously, transactions change, terms change, you have valid change of circumstance. In that case, a revised loan estimate has to be delivered within 3 general business days of receiving information sufficient to establish the change. Now that's whether the information is received by a broker or a lender. So in the case of a wholesale transaction, it's imperative that the broker and the lender are communicating. So if a borrower communicates a change or request to the broker, that's communicated to the lender if the lender at that point has taken ownership and issued the loan estimate. General business days also applies to the interest rate lock, noting here that, or the 3 general business days, noting that was a change that was revised in January. Originally the rule was stricter regarding rate locks. Wanted to also point out that the loan estimate or the final loan estimate must be issued 4 specific business days before consummation or closing. And the reason for that is there cannot be overlap between the issuance of a loan estimate and the CD, which means once the closing disclosure has been issued, you cannot issue a revised LE on top of it. Next slide, please. So we mentioned that the loan estimate is triggered based on the application. We have been used to since 2010 that for purposes of RESPA that there's a 7-item definition for the application. That has been revised to only 6 items. It's a uniform definition. It means whether it be a mortgage broker, lender, bank, everybody's on the same definition for what an application is. The 7th lender-chosen item, also known as a catch-all item, has been removed. So once these 6 items have been received, the initial disclosure obligation is triggered. Now there's talk about how you can do this so that you're not necessarily getting the 6 items. There is guidance that allows the sequencing of items, but once you have the 6, or once or if the borrower wants to present the 6th piece of information, a lender or broker cannot refuse it, and then that will trigger the requirements of issuing the loan estimate. Next slide, please. Mentioned here that obviously brokers are taking applications all day long, and that will continue. But important thing here is that whichever, doesn't make a difference who receives the application. There is an initial disclosure requirement that is triggered by receipt of those 6 items. There's a lot of discussion about who is going to issue the initial loan estimate. The wholesale industry, just like we've dealt with for the last 4 or 5 years, there's been a lot of changes, and there's no uniform answer on this yet. And the guidance about what makes sense really depends on this particular lender, the situation, and so forth. And also there's a technology component. So at this point, the rules are that either can issue it, and as we get closer, we'll be finalizing the workflows here for REMN Wholesale. Wanted to mention here that if the broker provides loan estimate, the broker must comply with all relevant requirements as if it were the creditor. If the creditor is unknown, the broker would leave the loan ID number and the lender info blank. And the reason that's critical is because the loan ID number or the loan number can't change once the loan estimate is issued. So if a broker were to issue a loan estimate with their loan number, then a lender who took that loan estimate in would have to use the broker's loan number to close the loan, and it's just not practical. So if the creditor accepts the loan after the loan estimate has been provided, the creditor is bound by the tolerance limitations. I'd like to quote here that even if the broker provides an erroneous disclosure, the creditor is responsible and may not issue a revised disclosure correcting the error. The creditor is expected to maintain communication with the broker to ensure that the broker is acting in the place of the creditor. So these are dynamics that, while we're used to some of this, definitely it's heightened scrutiny, and once again, there is a heightened burden on the lender when it comes to accuracy of the LE and the ultimate liability associated with it as well. Next slide, please. Before we get more into the details of the loan estimate, I wanted to just briefly talk about, prior to application. There's been some discussion about, how is the transaction impacted by these rules when it comes to borrower shopping, comparing lenders, comparing brokers, and so forth. The rules do have some guidance on that. There is an allowance for a closing cost worksheet to be used, similar to what people have been using since 2010. There are some very specific rules about that, including disclaimer language, with the goal really being that prior to application, if anybody is going to issue a worksheet for the borrower to use, that the borrower realizes clearly that it is not an official loan estimate. The broker or the lender is not bound by those disclosures at that point, the fee disclosures and so forth. But once again, from a workflow standpoint, that shouldn't impact anybody once they realize that they have to use a form that complies with the requirements. Next slide, please. So we're going to talk about the concept of good faith here. So obviously forever we've used the term good faith estimate and good faith and so forth, and what does that mean? And with the new rules, there's definitely enhanced definition of good faith, pointing out here that the loan estimate figures must be made in good faith and consistent with the best information reasonably available to the creditor at the time disclosed. If the broker's issuing, it's the same thing. So that's pretty broad language. What's the best information at that time? And that's a problem, because when those things, those subjective type things come up, it's going to be difficult to figure out, have I operated in a compliant fashion? Have I exhibited good faith? So there's some guidance on what does that mean. So how do we determine good faith? We look at the difference between the estimated charges originally provided in the loan estimate and the actual charges paid by or imposed on the consumer, which on its face means, you've got to nail it when you disclose, unless there's a valid change of circumstance that allows you to update it, update the fees. So generally speaking, if a charge paid by or imposed on the consumer exceeds the amount originally disclosed on a loan estimate, it is not in good faith. Okay, we'll talk about those exceptions going forward. And once again, this is true regardless of whether the creditor later discovers a technical error, a miscalculation, or an underestimation of a charge, which basically means there's no whoops here with these disclosures. Next slide, please. I want to briefly talk about the concept of change of circumstance. The framework for change of circumstance is very similar to what we are used to since 2010. We're going to just go through this relatively quickly. As a general rule, creditors are bound by the loan estimate and may not issue revisions because they later discover technical errors, miscalculations, or underestimations of charges. That's the same as what we just previously said. We may only charge more than the amount disclosed when the original estimate, or lack thereof, was based on the best information reasonably available at the time of the disclosure. So now we're going to talk about when can we issue a revised loan estimate. So we have changed circumstances that occur after the loan estimate is provided to the consumer that cause settlement charges to increase more than permitted. Examples of this can be, will be on our FAQs. And once again, this is similar to what we're used to from the HUD guidance back in 2010. There's also changed circumstances that occur after the loan estimate is provided to the consumer that affect the consumer's eligibility for the terms to which the consumer applied or the value of the security of the loan. So an example of that would be if the appraised value comes in lower than expected and triggers mortgage insurance requirement based on the LTV, that would be a valid change, and mortgage insurance could be disclosed at that time, and that's an acceptable way. Revisions requested by the consumer. This is critical because obviously throughout the life of the transaction, things change. And borrowers want to change things. They want to change their down payments. They want to change maybe their loan program, the structure of their loan, whether it be points, no points, and so forth. And borrower-requested changes are allowed, just as they are today, and those will trigger the revised loan estimate. The fact of going from an interest rate that was floating to a locked interest rate, another valid change as it is today. And also something that we're used to today with the intent to proceed, which is that if the consumer indicates an intent to proceed with the transaction more than 10 business days after the loan estimate was originally provided. That's the same as it is today with GFEs from 2010. Once it's issued, the borrower has to exhibit intent to proceed. If they don't do it within 10 days, then for all practical purposes, the values on that loan estimate can be revised. And also wanted to mention here that there is some specific guidance that came out recently in the last couple months regarding construction loans, and there's a place on the loan estimate for specific information to be disclosed about how fees associated with a long-term transaction like new construction can change. Moving on, please, to the next slide. So we now get into the form, talking about some basics first. As I mentioned before, the way the form is set up, the loan estimate and also the CD, the most important information in the eyes of the Bureau for a consumer, is first. So we have the interest rate, payments, the cost of closing. There are some design things that are also different than what we're used to today, which are that you'll see in the loan estimate there's a lot of rounding to eliminate decimals, which are deemed to be confusing for some folks. Also, when it comes to percentages, you'll see that you can go up to three decimal points if there is an interest rate percentage and so forth. But, for instance, if it's 4%, you're not going to see 4.000. You're just going to see 4. Once again, as I mentioned earlier, blank fields we're not able to use, NA are not applicable, and so forth, and inapplicable sections or tables are removed entirely from the form. So this is page 1 of the loan estimate. We're just going to pause here for a second, look at it, and then we're going to go section by section. I think the most important thing here is when you look at this document, it doesn't look like a GFE or a TIL. You can look at it and you can see pieces of either of them on this form. You see the projected payments, which definitely looks more like a TIL. The upper section looks like like either form where there's some basic information. The loan terms, once again, primarily GFE stuff. And then as you go through it, you'll see that there are elements of each of the things, the GFE and the TIL, that are combined here. Hopefully, at the end of the day, when a consumer looks at it, they'll see the most important things first. And hopefully, when you're working with the consumer, having to explain the disclosure, it will be easier on the MLO or on the process or whoever is discussing with the consumer to explain their loan to them. Next slide, please. We're going to talk about the top of the form first, and we'll go through it pretty quickly because most of the stuff is what we're used to seeing. There is a date issued field here now, and the important thing with the date issued is that this is the date that the loan estimate is mailed or delivered to the consumer. The method of delivery does not affect the date issued. If it's hand-delivered or mailed, the date would be the same, and that's the same if it was being electronically delivered as well. Obviously, we have our property address. We have the sales price on a purchase transaction. If it was a refinance, the estimated value would be listed there. We have the loan term. We have the purpose. We have the product. I wanted to emphasize here that product takes on a new dimension really with integrated disclosures because of the fact that a product change will trigger subsequent redisclosure. It actually becomes much more critical than it is today. Also wanted to mention here again the loan ID number, as I mentioned before. That loan ID number, once issued on the loan estimate, is going to stick to that transaction through subsequent revisions and all the way up through and including the closing disclosure. The last point I wanted to mention here is about the rate lock. So you can envision what a good faith estimate looks like today. You have the important dates section. Most of the important dates have been consolidated into this little paragraph here, focusing on first, whether or not we have a rate lock. Also there in the fine print, you'll see bolded whether the other estimated closing costs expire and when they do. That's the consolidation of what we're used to seeing from the GFE. Also wanted to point out here is that there's time zone requirements. So you can see for each of these dates here with the expirations, there is a time zone requirement. There's no rule that says what it has to be, but it has to be posted there. Next section, please. So we'll look at the loan estimate, the basic terms. Obviously, most important things first, loan amount, interest rate, monthly P&I. You'll see here that the P&I does have decimals. The dynamic nature of this form is the second column to the right here. Indicates the borrower very simply yes, no, whether this amount can increase after closing. These are dynamic sections. So for every time that there is a yes indicator, then there has to be corresponding explanation. An example here, even though we don't offer prepayment penalties, this is an example of what would happen if you were. There's a yes indicator, and then there's a description there for the consumer to hopefully make it easier for them to understand whether or not an increase applies to the loan, and if so, what it is. Next slide, please. So this is the projected payment section, which, as I mentioned before, definitely looks more like a till, and you can see that it's pretty simple. We would hope, at least in this example. This example here is a loan that has mortgage insurance for years 1 through 7, and then years 8 through 30, the mortgage insurance drops off, and then you have just a dash there where that value was. This can be expanded up to 4 columns. That's the maximum allowable. So a more complicated transaction, adjustable rate, or if there's interest only or things like that that are going to have more permutations, you'll see up to 4 columns listed here. And the simplest version of it would be just straight years 1 through 30. Wanted to point out just a couple of other elements of this form here. You'll see here that there's a specific section for escrow. Okay, we have the estimated escrow as part of the payment, and then below we have the breakdown of that, of the escrow components: property taxes, homeowners insurance. That does not include mortgage insurance. You can see that the mortgage insurance value is not included in that 206 number. You can also see that there's an in escrow question, yes, no. In this particular case, these are included in escrow. There is a consistent theme with the loan estimate and the closing disclosure to give borrowers as clear as possible disclosure when it comes to escrows, what's included in their monthly payment, can these things change, and so forth. And that's a consistent theme, and I think that's because that's one of the areas that historically people have confusion about. They raise issues after they close about what's included, what can change, and so forth. So hopefully this will eliminate some of that confusion going forward. Next slide, please. So when we're tabulating the bottom of this, we have total cost of closing. And once again, the goal here is not just what my closing costs are. It's what's my total cash to close. And you'll see as we get into the next, the next slide, that that's a theme throughout this transaction. Throughout the form, that there's a goal of giving the borrower complete information. In this particular case, you have on top a purchase transaction, and in the section below, you have a refinance transaction where the borrower is getting cash back. And once again, the descriptions there are different than what we're used to. It's kind of breaking it down where the totals of each sections are coming to, and then flowing into the bottom line numbers for either the estimated cash that it's going to cost, or if they're getting cash back. Next slide, please. So we're going to move on to page 2. And this is the section where there's a lot of changes from what we're used to today. Primarily, this is GFE stuff, and there are a lot of design principles that are different than what the current GFE looks like. I'm going to just talk about some of the broad changes, and then we'll go through it section by section. The first thing, obviously, is it's visually different. The sections are different. The titles of the sections are different, at least for some of it. You'll notice that within each section, there are alphabetical fee naming requirements, and that's a new requirement. If you just look at the loan cost section, you'll see that after the points, the 2 fees are listed alphabetically, and if you look section by section, you'll see that was design principle based on the CFPB research saying that it's easier for people to find things when they can look alphabetically. So when they want to look for a certain fee, they don't have to go searching all over the place. They can just go ABC, where's that fee? Also, you'll see that the structure that we're used to, either from a TIL or a HUD-1 and a GFE, where you have the various sections, your 1,000 section, your 800, and so forth, that's gone. You won't see it anywhere on either the loan estimate or the closing disclosure. A lot of LOS systems are still using that structure because people are used to it. It's basically the background. The itemization is still kind of a core, fundamental way in which we deal with fees. But as far as the way those fees ultimately get displayed to a consumer, that framework is gone. We learned in 2010, it took us a long time to talk about blocks, when it came to the compensation, and then each of the subsequent blocks going down, that entire block structure in the framework of the GFEs is gone. You'll also see here that the dollar amounts are rounded. And important point here for brokers. Lender paid compensation is not disclosed anywhere on the loan estimate. We would think that it would be in that loan cost section. That's kind of the equivalent of what you have today, the origination charge section on the GFE, but it's absent, it's purposeful. The Bureau basically came out and said the borrower, it's not a borrower paid charge, so it's not going to be disclosed here. Many think that that was a win, for the mortgage broker industry because it kind of leveled the playing field. Lenders not having to disclose, secondary market compensation or secondary market gain, and brokers having previously had to disclose what they're being paid indirectly by the lender. So that's off the table, pointing out that it does appear on the closing disclosure, even though we're not going to get into that so much today. So now we'll get into just some of the detail on the loan cost section. So the next page, please. So I'm not going to go through every line, every section, but just the basics. As we mentioned, the blocks are different than what we're used to. Within each block, we have alphabetizing. In the origination chart section, that first line, the percentage of loan amount, is reserved specifically for points. They are points that have to reduce their interest rate, but they are not bona fide points based on the definition of QM or other definitions that exist out there. So that's, on one hand, it's a good thing. That's the only place that points can be disclosed. On the other hand, it doesn't mean that calculations about whether or not a point is bona fide based on either QM or a state requirement or other requirement, those calculations have to be done separate from that. This is the only place also that a fee that's exhibited as a percentage can be listed within the loan costs. Going below from that, application fee, underwriting fee, and so forth, commitment fee, those would be listed there in the alphabetical order. Just like we're used to today, origination charges remain zero tolerance, so they can only change with a valid change of circumstance. The next section is new in that fees have been now broken up based on whether or not the borrower is either shopping, can they shop, or can they not shop for a specific service. That's different than the framework that we're used to today as far as how this is listed. So in the services that you cannot shop for, customary things that we're used to as lenders or brokers defining for the borrower who they're going to use. The borrower can't pick the appraisal company or who they're going to use for credit or the flood or and so forth. So you can see that those fees are enumerated here. They're enumerated alphabetically. And these are zero tolerance, and that's new. Okay? If the borrower cannot shop for it, if it's a mandated vendor or a mandated service fee, it's in the zero tolerance bucket, and that's different than what we're used to today. Moving down to services that you can shop for, the borrower can shop for. These are the things, the third-party vendors that we're used to seeing, survey, title, and so forth. These are 10% tolerance items unless they're paid to the creditor or an affiliate of the creditor. Want to also mention a change here in the layout of the form. It's alphabetical, but every fee that relates to title has to start with the word title. You have title, hyphen, and then the description of that fee. That's different than what we're used to today. If we look at bills that come from a title company or a solvent agent, that's not the way they're set up. So there's work that they're going to have to do as well with this. So next slide, please. So we're continuing talking about, this is basically the right side of the loan estimate. And these are things that we're used to today, so we're not going to spend a ton of time on them. Once again, from GFE, a lot of this stuff carries over, your taxes and other government fees such as recording and transfer taxes. Wanted to mention here that these, in that section, E, those are predefined items. You can't add any more lines. So if you have multiple, fees in those categories, those have to be lumped together. As they are today, recording fees are 10% tolerance and transfer taxes remain zero tolerance. The sections regarding prepaids and escrows are very similar to what we're used to today. And then now there's an other section. So owner's title policy, is now listed in the other section. It's not necessarily required. It's optional for the borrower to get an owner's title policy. Other types of fees here, such as home warranty or inspections and things like that, that are not necessarily lender required but are common and customary, may be listed here. And then obviously all these costs are totaled. Next slide, please. So as we get through this, there's a couple things we want to point out here. There's a calculating cash to close section, and that's different than the way things are displayed today. It definitely looks a lot more like the details of a transaction on a 1003. You'll see that there's a place for the down payment, so the estimated total down payment. If there's any earnest money deposit that was given up front, that's listed there. And then there's also places for seller credits and so forth. There's a critical area that needs to be looked at here when you're dealing with your LOS provider, which is, how does this calculating cash to close section line up with your 1003 details of transactions? because they may not necessarily be the same fields, which means that when it comes to accuracy, keeping track of things within your transaction, you may need to do things in 2 different places, and that's just something to be aware of. Also wanted to point out here is that there are different versions of the loan estimate. There's a purchase version, there's a refinance version, also known as an alternative version. And you'll see for the refinance version, obviously it's truncated, less information there. And then also you have the checkbox as mentioned before, whether or not you're getting cash back or whether or not you have to come to closing with cash. And also wanted to mention in J, before we move on, that if there are lender credits, that's where they would be listed. That's hard-coded item. If it doesn't apply, then it comes out blank, not an A, and that doesn't disappear because it is a hard-coded item on the form. Next slide, please. So now we're going to go to page 3. And once again, the last couple of years been used to the requirements of disclosing licensing information, whether it be the state and or NMLS. In this particular case, both have to be disclosed. So for the individual loan originator, their state, if the state has a licensing requirement or license ID specific, has to be listed along with the NMLS. That applies to both the lender, and if there is a broker, that applies as well. The next section, the comparison section, is new as well. The first is a 5-year comparison, which is to give the borrower an idea of what this loan is going to cost them in the form of principal, interest, mortgage insurance, and loan costs for the first 5 years. And that's different. But once again, the goal here is what's more, let's just say important for a consumer to really figure out when they're shopping. What's the loan going to cost them over 30 years, or what's the loan going to cost them over 5 years? So it's a more practical way to identify costs and to compare and to shop. There is a consistent theme with these disclosures with the home toolkit, which is new and replaces the HUD settlement cost guide, which is that the CFPB was very much in favor of giving the borrowers or potential borrowers avenues to cost shop, to look for different vendors to do things for them, to settlement charge shop. So it's a big difference than what we're used to today. Another big difference there is a good segue is that the APR is on the last page. So we've moved from the till, front and center on the till with the APR to really embedded on page 3. And it's there because, once again, studies showing that the APR is confusing, not a tremendous amount of value to consumers when it comes to them actually comparing products and actual costs. But from a lender and a broker standpoint, APR is still important because we still need to do tests that are based on the APR, whether it be rate spread tests, other types of compliance types of tests at the state level and so forth, HPML and so forth. They are all based on APR, which means we still have to have accurate indications of fees that are included in the finance charge, and we still have to calculate an APR. A new calculation that we have to do is called the total interest percentage, or TIP. It's a scary number. That's going to be the one that's going to replace the APR when people have questions. When borrowers have questions, at least a lot of people think this is what they're going to ask about, if they make it to page 3 of the loan estimate, that is. So the TIP is the total amount of interest that you will pay over the loan term as a percentage of your loan amount, and that's basically another challenging figure. So I'm not going to get into it today. There are other explanations on the CFP website and so forth about the TIP, but pointing it out that when people see numbers this big with percentages, chances are that they're going to ask questions about them. As we finish up page 3, just wanted to mention that there was some consolidation of disclosures. This was to make some things easier, not necessarily everything easier, but some things easier when it comes to consolidating information that we're giving to borrowers. A lot of this is from the till. You'll see that the assumption, the homeowner section, the late payment section are all from the existing till. The refinance verbiage is from the till, and the language has been slightly changed. All the way at the top is the ECOA appraisal disclosure. So that eliminates, on one hand, having to have a separate disclosure for ECOA purposes that we had to start dealing with earlier. But if the borrower wants to waive the 3-day requirement for receipt of the appraisal, you still have to use a separate form for the waiver. So it helps a little bit, but not necessarily all the way. And at the bottom, there's a servicing disclosure. So right now, there's a servicing disclosure requirement. This form replaces that requirement. Last thing on the form is a confirmation of receipt. So the point here is that there's a place for the borrower to sign, but this does not indicate intent to proceed. So in 2010, we all got used to issuing GFEs with a separate intent to proceed form. That's still going to be a requirement. So the borrower has to independently express their intent to proceed to move forward with the transaction. Next slide, please. Going to spend a couple minutes here just talking about the concept of tolerances and limitations, and then we'll go into some Q&A and wrap it up. Once again, the concept is very much similar to what we're used to since 2010. Just wanted to point out here that you'll see the term tolerance. You'll also see the term variations. For all practical purposes, they're interchangeable. The zero tolerance items that we wanted to point out are the items that the creditor may never charge more than the estimated amount unless there is a valid change of circumstance. These include fees paid to the creditor, to the mortgage broker, or an affiliate of either. Remember when QM came out, there's a lot of questions about fees being paid to brokers and creditors and when certain fees apply to which and what got included in the points and fees cap and so forth. When it comes to tolerance, so this is not a QM discussion, but when it comes to tolerances here, items in the zero tolerance section, which are paid to either a creditor or a broker or an affiliate of either, are included there. Okay. Also included here are fees paid to an unaffiliated third party if the creditor did not permit the consumer to shop. So I mentioned that earlier. That's different than what we're used to today because those fees are in the 10% category. Also, same as today, transfer taxes. Next is the 10% cumulative tolerance category. Once again, this is similar to what we're used to today, recording fees, third-party services not paid to the creditor or the creditor's affiliate, and when the borrower is permitted to shop. And then the last will be the no tolerance items, and those where things are once again used to today, prepaid items, homeowners insurance, escrows, and so forth. So that's a very quick summary of the variance. I will tell you there is a lot of detail in here, not on this slide, but there's a lot of nuances to the concept which we'll start, hearing about, which is, setting baselines for your tolerance and resetting your tolerances based on cumulative changes in the 10% category. It's beyond the scope of this webinar, but I can tell you that the framework is similar to what we're used to, from RESPA 2010, but there are a lot of details that are different, and that's stuff that's going to have to be vetted out the next couple months. So I guess moving on, Pam, what do we have next?
Well, we have received a lot of questions, which is fantastic, and keep them coming. As a reminder, with a copy of the presentation and a link to the recording, we're also going to be sending out our Q&A on this. So if I don't get your question, I apologize. We did get a lot of response and a lot of questions. So I'm just going to get to it, though. The first question we have is there some type of fee estimate that can be given to a borrower that's shopping prior to the actual application and issuing the loan estimate?
Okay, that is something that we did address on an earlier slide. Same framework. There is the ability to issue a closing cost worksheet. The CFPB did not put out a model form for that. They did put out guidance saying what the form can't do. The form can't be confused with loan estimate is really the underlying theme. So as long as the requirements are set forth and those are spelled out actually pretty clearly in the guidance, then it's okay to issue a worksheet, whatever you want to call it, prior to an actual application.
Great, thank you. We did get a few questions on this, and it was regarding the 6 pieces of information that we gather that would make an application now, and when we have to disclose, including the LE. Does the information have to be reviewed, and do you have to have documentation? Such as if you have a self-employed borrower, would you wait until they get their tax returns to verify their income before disclosing?
Okay, so that's a pretty loaded question. So once again, 6 items. Once you have them, and the you meaning either the broker or the lender, once those 6 items are received, it triggers disclosure. Further, what goes with that is that there's a prohibition on requiring verification of information, prior to issuing the LE. So in the example you've provided, can you hold back an LE until you've verified income for a self-employed borrower? And the answer is absolutely you cannot do that. So there is a nuance there that right now, and there's overlap with other workflow things that we're used to today that are going to be impacted by that. And maybe there's some other questions on that stuff, but the point being you cannot require verification of information.
Thank you for that. Will a change of circumstance affect the closing date, and what happens if the change in circumstance happens after a closing disclosure has already been issued?
Okay, so I think it's very similar to what we're used to today, at least when it comes to the LE. We can equate the fact that changes occur now change of circumstances, valid change of circumstances occur now that trigger new disclosure. When it comes to TILs today, APR variances change and so forth. APRs go up, that require reissuance of a TIL, and then 3 days and so forth. Those things, the framework for that is part of what we're going to be dealing with loan estimates and CDs. Just wanted to point out a couple of clarifications. First is that while we're not focusing on the CD today, the CD does have a specific 3-day requirement, which means the CD has to be issued to the borrower, in 3 days in advance of the closing. And then if there are certain things that change after that CD is issued, then that will trigger 3 additional days. There are 3 items that will trigger that. One would be the addition of a prepayment penalty. The other would be a change in product, which is something I mentioned earlier, why product becomes so important. And the third would be if the APR goes out of tolerance. Generally speaking, that's an eighth. There are some nuances to that, but for our purposes today, let's just say that if the APR changes by an eighth, you're going to trigger a new 3 days.
Thank you for clarifying that. Along the APR, I have another question that came in regarding this. Is there now going to be another form required to disclose APR, such as like what we have today, the itemization of amount financed?
It's a good question, and I don't know that the Bureau's come out with anything specific on that. I will say that, the forms facially, don't cover that. You'll notice that the forms don't indicate finance charges clearly. So I expect what's going to happen is that the LOS providers are going to, as I said, the framework for the itemization that's in the LOS systems is going to be there. The expectation is that they'll, have a form, a supplement to this that details the finance charges and how the APR gets calculated and so forth. That's the expectation, but to my knowledge, the Bureau hasn't come out with a model form for that purpose.
Thank you. Someone also on the webinar asked the question regarding appraisal fees. They feel that some of their AMCs that they work with may change the appraisal fee and they have not disclosed correctly. Would that be a valid change of circumstance?
It's a good question, and it goes back to the beginning. If you remember, the concept with the LE is what's the best available information at the time that the LE is issued, and what constitutes a valid change. So I think, it's hard to say, what's going to be an acceptable change in that concept, in that context, because of the fact that is it reasonable to think that whoever is issuing the LE knows what the fees are going to be for that AMC? And I think somebody would say, well, yeah, it's reasonable, but what may change? So does the property type change? You thought it was going to be a one-family, it turns out it's a mother-daughter or a two-family or something, or there's a rent schedule need or something that you couldn't anticipate. But at the time the LE was issued, it was done in good faith based on reasonable, the reasonable information that you had at that time, then that may be the grounds for a valid change. But I think it's going to be fact-specific, and I think that there is also a consistent theme throughout all of this that the reliance that lenders and brokers have with vendors is going to be heightened. It dovetails with the CFPB's emphasis on vendor management and the relationship between the vendors that a consumer has to use in connection with a transaction or that are being recommended on a service provider list. So I think it ties into the whole kind of universe of this. And once again, it's going to be hard to know exactly what's going to be the triggering event that says, yeah, that's okay for you to have to increase the fee for the appraisal because of X, Y, Z. So fact-specific is, I think, the best way to answer that one.
Thank you. And our last question that we have time for is, in your opinion, is there any possibility of this new rule, the TRID, being repealed or delayed?
Opinions. So repealed, I would say doubtful. I don't think it's getting repealed. I think that what you hear in the press is that the industry has had a long time to prepare for this. Depending on who you listen to, it's at least 18 months. CFPB was mandated out of Dodd-Frank to do this, so it's not like it's going to go away. I think that what you're hearing now today, 100-plus days out, is that the industry, for a lot of it, is waking up and saying, wow, there is a lot going on here. This is not just two forms. In the last couple of weeks, Deputy Antonakis from the CFPB commented about hearing concerns about technology implementation, the heavy reliance on technology and whether or not the technology providers are going to be available or, are they going to be, ready for August 1st. So I think that's one of the areas that is going to potentially have some impact on it. Whether it's going to be delayed, once again, it would be counter to the way the CFPB is operated. We experienced that with QM. We've experienced that with other things, that regardless of what else is going on, they have been, at least historically, very firm with their deadlines. My last point on that is that, there is, we hear from people that are out there lobbying, industry folks and so forth, that there is definitely kind of a groundswell of support to try to get at least kind of lax enforcement during the beginning. And if you remember back to 2010 with HUD and the RESPA changes, there was a 4-month period, kind of an adjustment period, where they basically said we're going to have lax enforcement because we realized what a dramatic change that was then. I think this is a much more dramatic change, but we're dealing with CFPB, not with HUD. So who knows how they're going to respond, but I have heard that there's definitely some momentum, with, people on the Hill and so forth to try to get some breather. Whether that will actually come to pass, I'm not a betting man, so I don't know.
Great. Thank you so much, Phil. And we want to thank everyone on the call today for joining us for this webinar. We know everyone's very busy, so we do appreciate you coming and spending time with us today. As a reminder, a copy of this presentation will be posted on REMNWholesale.com, and we will also send out a copy of the presentation and the link to the recording in the next 24 hours. And don't forget to register for Part 4 in REMN Wholesale's webinar series, which is focusing on the closing disclosure. So thank you all very much today. Have a great afternoon.